I'm Eileen Fahey. I'm joined today by Marty Fridson, publisher of High Yield Future Tense. The book is a compilation of a wide variety of viewpoints on high yield. Why did you decide to publish the book now?
Well, this book came about through the 25th anniversary of a high yield conference that's been run by the New York Society of Security Analysts, and I've had the honor of chairing that from the inception. And that makes it just about the longest running financial conference of any kind. So NISA very understandably decided to publicize this fact and bring out a book in conjunction with the conference. And there's been a lot of really good research going on in this area, and it was a good time to pull some of that together and take a forward look at how the market is likely to evolve.
Give us your perspective on what's happening in the high yield market today.
People have been worried that things would kind of fall apart when the Fed started to raise rates. Historically, that hasn't been the case. The initial reaction to an initial Fed rate hike has been a compression of spreads, actually, but nonetheless, you don't know. This has been an unusual cycle. But the initial response, again, has been fairly favorable.
Let's talk about liquidity. Tell me about the decline in dealer inventory and how that's impacting today's market.
Yeah, well, the liquidity in the market on a secondary basis has been deteriorating for some time. The causes that are pointed to include the intensified regulation for the banks, and particularly the Volcker rule, which has prohibited proprietary trading by banks. And that's made it more difficult for dealers to make markets and provide some of the liquidity at the margin. Now, when the market is going down and there are no buyers, no matter how many market makers and how much capital they have at work in bond inventories, you're not going to prevent that decline, and it's going to gap down. And that happens typically at some point in the cycle. But this has been aggravated, and the ability of dealers to make market has been further hamstrung by some of the new regulations. In addition to that, I think some of the unsophisticated buyers who might have been the outlet for paper that was bought by dealers were wiped out in the financial crisis. So that sort of element of liquidity has gone too. If there are dealers that are not constrained by the banking regulations, they have a freer hand, and it's possible that some of them will expand their activities. They typically do during bearish periods on a mostly agency basis, so not committing capital, buying the bonds, but helping in the search function, helping get people get familiar with the credits, and that is quite a valuable service. So that has happened in past cycles. It's possible that with the dealers that are housed within banks and are subject to the regulations pulling back, it's possible you'll see more capital commitment there as well.
Let's talk about the high yield market today, particularly regarding Third Avenue.
Well, the Third Avenue Focused Credit Fund announced that it was going to halt redemptions and put its assets into a liquidating trust. Now, after a couple of days with discussions with the Securities and Exchange Commission, they reinstated the mutual fund form, but the investors are still going to be prevented from getting their cash out. They'll get distributions along the way, but it could take a year or more. And that was really a shock to investors who had been accustomed to and expecting daily liquidity. And the initial response, understandably, was, well, are there other funds? If I'm a holder of another high yield fund, am I at risk of this happening to me? I think the story came out fairly quickly. Research was done. The media did a good job of covering this story as well. And it became clear that that fund was really a distressed debt fund. It was officially categorized as high yield under the SEC definitions of the different asset classes. But in reality, they owned an overwhelming percentage of the lowest rated paper. A lot of that was debt of companies in bankruptcy or at very high risk of that. And they were also much more concentrated in individual positions than the typical high yield fund. So I think that the realization came about, and even Janet Yellen in her comments about raising interest rates mentioned the fact that this really was an isolated incident. There were a couple of hedge funds that gated, but that's sort of a different thing, and that's something you expect in a downturn. But the idea of running a distressed debt fund with daily liquidity clearly was not a good idea, and I think the market recognized fairly soon that you were not going to see an outbreak of lots of mutual funds preventing their investors from getting their money out.
Chris Garman has a very interesting viewpoint in that he believes the high yield market will disappear. Can you comment on that?
Well, Chris is a great analyst. We formerly worked together years ago at Merrill Lynch, and he has a very big picture view, really looking at the capital markets, at the economy as a whole, and through a variety of trends starting to reverse from a very long period of declining interest rates. He foresees a capital market which will switch back to a greater emphasis on the traditional bank lending that has been disintermediated over the last few decades, and he sees the high-yield bond market taking a smaller role as a result of that. It's certainly a contrarian view. And I would say that if it turns out to be true, he'll look very prophetic, and it'll be a great credit to the book to being the first source out there predicting this kind of a change. But there are a lot of factors at play there, and we'll just have to see. I think separate from those factors, the high yield market has established itself as a pretty permanent fixture in the capital markets.
Assuming high yield is a sustainable and distinct asset class, let's talk about some of the tools in the book that allow for enhancing performance.
Right. When you look at the performance of high yield relative to other asset classes or even segments within the high yield market relative to one another, a real problem arises from confounding factors, meaning that you're trying to measure the difference, for example, between the performance of high yield and the performance of investment grade corporates. Well, the indexes of those two asset classes have very different durations. So you go through periods where the answer is one thing if you look at what the indexes say, but a different thing if you look at the actual performance of the quality of bonds, taking out that difference in duration. I mean, basically, investment grade corporations are able to borrow for longer terms than high yield bonds. So if you get a big move in interest rates, you'll have a big interest rate and duration effect that's not really a reflection of whether people were willing to take on greater credit risk or less willing during that period. So that's an example of how the measurement can get distorted as factors that are again, confounding the picture enter in.
Can you speak to the importance of smart beta and how this might enhance performance?
Yeah, the idea of smart beta has been in use for some time in the equity markets, has been well established, not as much in the fixed income and particularly in the high yield market. It's still a relatively new idea, and so I'm very excited about the fact that the book is bringing this in with a team from Fidelity that's done a lot of research in this area. And they talk about the practicalities of implementing this kind of a strategy. But the basic idea of it is that the index may not be the optimal mix of securities to hold because the standard indexes are based on market capitalization. So you wind up owning more of the most highly leveraged companies, which may not be the thing you'd really want to do. So while you do want to get a lot of diversification and capture the basic movement in the market, there may be a more efficient mix that you can arrive at, and there are several different approaches available for that. But I think it's a really exciting development and could again, generate a different type of portfolio, which is always a positive thing. I mean, the more diversity you have in the types of investors, the better it really is, because the greater the chance that they're not all going in the same direction at the same time.
Talk to us about covenants and recovery analysis.
Yeah, well, covenants are a very important protection. What you really want to do, most importantly, is prevent the company from re-leveraging after you've taken the risk. You are in a senior position in the capital structure in the event of failure of the company, but now you find that the assets that have accumulated are now taken out through dividends or more debt is issued. And so those protections are very important to your performance. Now, the covenants are part of the pricing. It's a part of the market like anything else. Covenants get stronger when the bargaining power shifts toward the investors. They get weaker when the bargaining power shifts toward the issuers. But in addition to that, you have the role of the underwriters. Now, the underwriters like to present themselves as sort of an impartial player helping to bring the buyers and sellers together, finding where the market clears. The reality is that the lead underwriter who gets the bulk of the economic profits from the deal is selected by the issuer. And nowadays, the competition for getting that mandate to lead the deal is not very effective if you're competing on the basis of price, because the market has a pretty good understanding of where a lot of the bonds that would be coming to market ought to be priced. So another way to compete is to come up with a new gimmick in the covenants, something that won't be recognized by the buyers as giving an advantage to the issuers. Now, they'll figure it out after a while, but you might be able to get a few deals in with a new kind of twist to the covenant that the market won't really recognize. And when you have that as the basis of competition, the tendency is going to be, in addition to the cyclical improvement or deterioration in covenants, a longer-term trend toward deterioration. And a lot of these innovations, unfortunately, get accepted in time as just part of the standard contract. And I think since some improvement in covenants from very weak covenants in the early days of the high-yield market, going back to the 1980s, there was some improvements, some basic reforms that went on. But I would say since then, the tendency has been in the direction of the issuers and to the disadvantage of the investors.
Let's talk a little bit about Fitch's chapter on recovery.
Well, recovery becomes very important not only when the company actually goes into bankruptcy, and a lot of mainstream high-yield investors will be sellers at that point because they don't really want to be holding an asset that's not generating any current income, which is typically the case, and devote the management time to participating in the workout process. But even before you get to that point, the secondary price will reflect the expected recovery. So if you have different levels of seniority of a particular issuer trading, then the more junior paper will trade at a lower dollar price than the more senior paper. And if you look at two companies with similar probability of default, but in one case a lower expected recovery in the event of default, that second issue again will trade more cheaply. So you don't really see that differentiation until the credit starts to deteriorate. So you can really get an edge if you're doing that analysis, taking that into account in your valuation before it really starts to be reflected in the market.
Asset managers will find lots of helpful information in this book.
Well, I think there's some great innovations in analysis. There's a chapter by David Ranson of HCWE, an economic consulting firm, and he has a really unique approach to asset class valuation and brings high yield into that analysis. A factor that people don't usually think about is the price of gold, but he shows the relevance of that. And I think that's a really compelling kind of analysis that's well worth taking a look. There's a very good piece by Bob Critcheff of Schenkman Capital Management, who talks about benchmarks and the challenges of creating a benchmark that really works in high yield where you have a lot of illiquidity. It's very hard to replicate the full index because a lot of issues don't trade on any regular basis. There are a lot of transaction costs that are not captured by the index. So while he points out it's necessary to have them, it's important to understand some of the limitations of indexes in order to be able to use them effectively. So I think there's a lot of great thought in the book, a lot of excellent tools for portfolio managers and asset allocators within institutions to get a better handle on the high yield market and be more effective in using that asset class.
Thank you for joining us, Marty. The name of the book, High Yield Future Tense.
Thank you. It's been a pleasure.